taking losses for months and months in a bear market, you're so conditioned that you're afraid to take a breakout. So it's the opposite way too. If you get on a good run, maybe right now you're holding 2 or 3 winning stocks that are up 50%, and you're saying, wow, everything's working, I'm going to really load up. That can get you into trouble. Just because you've gotten out of the gate with some winners, that's great. You still need to manage the positions and be objective to say, if I see some real danger signals and sell signals, I need to act. Not just because I feel good because I'm up 50%.
Welcome to the Rose Show podcast. Thank you so much for joining us today. We're here with John Pocorobba. He is a growth stock trader for over 20 years. His main job is an architect, but you could never tell that by his excellent, valuable insights on the markets. He has a great YouTube channel, and he's a co-leader of the Boston IBD meetup. And he's also founder of a Blue Sky investing event, which has grown tremendously. And we're going to give you details on how to attend the next event. So how you doing today, John?
Thanks so much for having me today. It's great to be here.
Absolutely. We're so happy to have you and talk markets, psychology, sentiment, and more. First, I got to ask you, Rain King, what's the significance of that?
Rain King came about kind of episodic, about 10, 12 years ago when I wanted to get on Twitter. Everybody says, well, you got to have a name, you got to have a handle. And being in stocks, people say, well, aren't you supposed to make money and make it rain? And I said, yeah. Somebody said, you should be the Rain King. And I said, okay, I'll go with that. So it's been around for a long time, and it's catchy.
It is catchy. I love it. I think it's cool. Thanks so much for that. So tell us about your background into the markets. I know you've been a growth stock trader for over 20 years. You're also an architect. How does that all come together?
Well, I think that I got interested in investing back in the 90s, really through William O'Neill's book, the Can Slim methodology.
Excellent.
And I have to say that I was so into my career that the investing was kind of just, I'll say, dabbling, and did not really take advantage of the .com bull market as much as maybe I should have, because I was only part-timing stuff. But I really got serious when the bull market started in 2003 and 4. Got much more serious about, applying myself to the market and being more regular and having routines, and started to have more success, go through all the early mistakes that all investors probably make. And then eventually, you start to narrow those down a bit and expand your knowledge and just keep improving. It's important to just keep improving, keep learning things that apply to your methodology, and gradually you'll get better results. And then that just takes time. It takes, experience.
Absolutely. Mistakes are educational experiences. And I think that's how we learn, and we keep learning and growing. And the market teaches us new lessons every day. There's so much uncertainty, and it's always changing. So we're always adapting and learning, and it's a lot of fun. And, you mentioned starting in 2003. I have to say it's a great time to start. Watching and observing the .com for many was probably better than having experienced it, because there's a lot of stories of people losing their shirts during that time period. It was a very difficult time period. I was trading through that time period, and it was very challenging, as was 2007, 2008.
Yeah, I know a bunch of people that were trading more seriously, and they made huge amounts of money in 98 and 99, but they gave all of it back in 2000, 2001. And by 2002, they had kind of really given up. And it was, kind of a shame, because if you couldn't hold on to it, it was disappointing. But some people did, which is fantastic. Other people weren't so fortunate.
Absolutely. Well said. It's exactly it. And try to remain neutral through those time periods. And, you have to have risk management #1. And, the human emotion gets involved. You get that euphoria feeling when those tops occur. And, it's hard to have to sell out and take your profits, but that's how the market works. And we have to sort of think different and go against the crowd. And that's what we're going to talk about today. So I want to focus on the current market trend. And what I like to do is I don't just look at day to day. I'm more of a swing to long-term investor. So I like to look at the patterns and historical cycles. And we can start from, this past 9-month period or so. And since October, let's talk with October. Now, we never know when the real bottom occurs, only in hindsight. But for now, I like to say it's the near-term bottom, October. Since January, it's been off to the races. It's been a nice rally forming. I know we had the banking crisis hiccup there, but there are always pullbacks along the way. But since January, we've seen a nice rally. Now, some people like to label things. I know we like to simplify things as humans and say, oh, we're in a new bull market. Others say it's a secular bull market that started in 2009, a 26-year run. We're midway through. It's going to be going on till about 2035. There's a lot of different thoughts out there. What I like to know is your thoughts, John. What are you thinking about this breadth that's going on right now? It's broadening, and the secular bull market argument.
Yeah, we could talk about this from the really big perspective. And actually, I do have a slide I could pull
Perfect.
up.
Thank you.
Let me
Let's do
see
it.
here.
Visuals are excellent. Wow, I love those charts.
So let me just put this. This is a chart, a long-term chart of the NASDAQ. And when this market super cycle, and when we talk about 2009, when we had the financial crisis, I've been showing this chart in my videos for a long time, that when this bear market started, I kept telling people, these long-term trend lines along the lows and these long-term from 2003, I said this market could come all the way down to maybe the psychological 10,000 level and be almost 30-something% correction. I go, but we could still be in the super cycle. And people said to me, really? Wouldn't that just be the market just fell apart? And I said, no, I don't think so. I think it would still be holding in the super cycle. So let me share a slide that talks about this demographics driver of the super cycle. And this is showing from some 74 to
yes,
to 82, 83, the market, ground higher, but it was very, very tough. But then the key driver was the baby boomers. The baby boomers entered what we call their peak consumption years in 83, 84. And that led to the super cycle from 84 all the way up to the top in 2000. Now, it wasn't a straight line, because we had multiple bear markets, the 87 crash, the 90 bear market with the Gulf War, and we had that really sharp 98 bear market. And I use that and I compare it to this super cycle, which, as you mentioned, 2009. Coming out of 2009, we kind of made our way with the help of QE to have a 10-year run. And when there was a lot of gains, and people said it can't go anymore. But the challenge to that was, well, there were 84 million millennials entering peak consumption right around 2018. And it set up this demographic driver of, we could get an extended run that could play out till 2035, a 26-year period. Again, we've had bear markets. 2018 was sharp and short, and COVID was really abnormal. And now we've gone through this bear market, and the millennials actually are in a position right now where they're turning 40, so they're entering peak earning years. They're going to be buying houses and cars and financial services, in addition to the boomers are going to be retiring, and they're going to be spending money on healthcare and second homes and transferring wealth. So that was the premise behind the super cycle. And when you put this in a long-term secular chart, and this goes back to 1942, there are these big bull markets, secular bulls. And, you can see here that from roughly 1950 to 1967 was a 25-year window of advances, then a long digestion of multiple years, which the nasty bear market in 74 is a major low. Then we just reviewed this up to from 82 to 2000, 26 years. And then we had the major low in 09. And if you believe in this, we could be going 26 years with, in theory, take us out to 2035. And, when you run some numbers, and I know Chicago Capital has run some other studies off the secular bull, and there's a case to be made to say that we're maybe halfway through this super cycle, which the good news is there's a long way to go. And the S&P, depending on how you look at it, could go up another 150 to 200% if you use some similar markers in similar super cycles. So it's kind of interesting to look at it that way, to see the really big picture. So those are my thoughts about, I do believe we held during this 2022 bear market. And, if it plays out, we still have a ways to go.
Absolutely. I have a question for you. Now, there's a lot of talk about looking at it from a different time period. And instead of saying that 2009 was the beginning of the secular bull market, instead saying that 2000, thank you for that, 2000 and 2008 were actually cyclical bear markets, and that the secular bull market began back in 1982. And we've had this, and it's basically due to the cycles of inflation, rising debt, and that we're actually at the late stage of this secular bull market and heading to a secular bear market. What are your thoughts on that argument? Have you heard that argument?
Yeah, I think, definitely it's a valid way to look at the market. We're experiencing higher interest rates than we've had. I wouldn't call them high interest rates historically. When you go back to the late 70s and early 80s, when rates were 15 to 18%, and inflation was higher. So it's taken some adjustment, because in the last 10 years, we're not used to 5 to 7% interest rates. So it feels, it's painful. Inflation has reared its head, which is can be a problem if it's sustained. So, I'm sharing the way I'm looking at it from a secular bull market. And I think the difference is I would not discount the millennials' earning power and spending capacity. That's a powerful driver. And combined with the boomers are retiring and spending their money on, like I said, second houses, vacations, etc., and transferring wealth. That wealth of the boomers is going to be transferred to many millennials. So those drivers are really where I'm focused. But I think, depending on your perspective, interest rates have changed. Interest rates are not a bull market killer. You still can have a rising bull market with interest rates. It helps if they're going down, but that could supercharge a bull market. But I wouldn't say because of that we're doomed.
Absolutely. I think historically our rates are not really that high. And, absolutely. And, we have a recency bias that we think they're so high because they were so low. And I think that it was an unhealthy level. Negative rates, free money is really what contributed to the banking crisis and a lot of the issues we have. All this money went towards riskier assets. And, and those are probably more issues to come. And, core inflation seems to be embedded, entrenched. And, it's about 5%. We'll see where it heads next. But that also is a concern of the money supply shrinking. So a lot of those issues coming forward. People are talking about a recession next year. Who knows? But let's focus on the markets. We don't need to talk about macro right now. So what's driving this rally, in your opinion, John? Is it the liquidity? I love that. I'm going to just mention the consumption. Excellent points. Very important to talk about consumption, because it's about who's spending the money, where's the money coming from. Consumption is key. So you think it's more liquidity, or do you think it's AI? Because AI, to me, structurally changes the way we live our lives, the way we work. And it's like a whole revolution in itself. Do you think it's all these factors? What are your thoughts?
Well, I do think, the Fed has had to take, what would be aggressive actions in raising these rates in pretty big chunks because of inflation. Now, a lot of progress has been made. Things are tipping down, which is good. It's still getting from 5 to 2 is going to be hard to get that really out of the system. and with the Fed trying to reduce their balance sheet, there is some tightening in liquidity. Now, in spite of all that, if you believe in America as a country in terms of entrepreneurs, and then you talk about the theme of AI, as you mentioned, AI is at its infancy stage in terms of being deployed on a larger scale level, and there are parallels to the internet in '95, say, where the build out of the internet took a good, well, it's probably not built out completely, but this took a complete 10 to 20 year period where initially there was the backbone and fiber networks that were enabling the systems of the internet. Cisco was a huge winning stock, which was connecting computers, JDS Uniphase, etc. And then eventually you had the applications such as the browsers, Yahoo and AOL and Netscape and all of those companies, and then eventually it gets down to all the applications touching the retail people in terms of using the internet, and then it becomes mobile, and it just keeps going. And AI is, seems to be at that tipping point now where the build out, and we're seeing that NVIDIA is a dominant player with their chips are an enabler of all of this artificial intelligence. It takes a huge amount of computing power. So NVIDIA is seeing a surge. And then you have the companies like Supermicro, which create these AI-enabled server farms that are, they try to reduce power. You have a green, sustainable angle to them. So a lot of the infrastructure we're hearing about now, which is great. And there's going to be winners to come out of that. But this is just the beginning. We're hearing Google's tools and Microsoft's tools. They're talking about their tools, but they haven't really put them out there for, I'll say, purchase yet, for companies yet. At least it's on a smaller scale. So we're just getting started. And I was on a Spaces last night where I think 2024, if this continues, is going to be a year rich with IPOs, because there are companies that we haven't even heard of yet that are going to be creating applications and uses for AI. They'll come to the market, and come to market, and I think they'll be received well as the future. So I think there's potential for a lot of new names in 24, 25, if this rally continues. So I think that's really encouraging that AI is going to play out over a decade or so. So no one's late to the party, but it is a big driving force.
Absolutely. I agree. I think AI is shifting the way we do business and live our lives. And we've been in a state of declining productivity for quite some time, and it's accelerated. So challenges bring forth opportunities, and they birth new industries. And AI automation is much needed. We have a dilution of value across the board, without even talking about the margins being compressed and corporate profitability. So I welcome AI, and I think it has much benefits, and it's just revolutionizing things. And that's an interesting point that you mentioned, new IPOs and more companies coming forth. So that's exciting. This is an exciting time, would you say?
It's a very exciting time, just like the intranet was a very exciting time, where all of these companies, many of them came up with all kinds of ideas of how to sell direct to consumer, e-commerce, these things that we had never heard of before. Companies emerge with entrepreneurs that have ideas, with applications, and we'll see it again. And there are a number of young companies right now taking advantage of some of these trends, but there's going to be more. I mean, you think of companies like Mobileye, which is driver assist, which is enabling the advancement of autonomous vehicles. Samsara is actually a young company that is using AI in deploying management of large fleets of vehicles for different companies. And then there's all the players in between, the database companies that help you manage and access data in really high speeds to use it. The companies like Confluent and MongoDB and Palantir is clearly using AI. They're one of the people that are actually using it. So there's going to be even more. It's just the cycle of new companies, new names, and that's why we have to be open to new names that may have new products and services, because there'll be some big winners there. We see it every big bull cycle.
Absolutely. This is the time for innovation and efficiency. And that's key. And being growth stock investors, I've been for a long time, just like you. And it's always exciting. I love this technology. MDB, you mentioned. I like Snow as well for data, a very unique company. And there's just so many of them. And Palantir, I remember that when the DPO'd, and great company there, fascinating stuff. It's like we don't really know much about it, but it's coming out. Right. It's just right. It's secretive, but it's fascinating, and there's so much more to come. I want to ask you about the sentiment. What are you noticing with the overall market sentiment lately?
Yeah, interestingly enough, back in April, I had seen some Bank of America surveys of professionals, and I recall that, and I actually included it in one of my market videos, that 95% of professional money managers saw the S&P lower by the end of the year, and they saw it below 4,000. And when I saw some more data about a lot of bearish positioning, a lot of shorts, a lot of hedge funds, a lot of concern coming out, particularly in April. I think there was a lot of concern about the regional banking crisis expanding. So a lot of negativity, even amongst the professionals. And I sent out a tweet at the time saying, could everybody be this right? When everybody's on one side of the boat, things can change in the opposite direction, creating fast moves. And I think my tweet said that, you know, if this gets some change and we can get above, I think it was 4,200 in the S&P, I said we could get a strong leg here, because everybody will be scrambling to get on the other side and close their short positions, change their mindset. And, you know, it was led by the big seven, you know, the big tech companies. But I think we're starting to see exactly that. People are saying, okay, we need to get positioned in a different way than we were back in March and April. That takes time at an institutional level. They can't do it in a day or two. So they have to shed positions. They have to take new positions. And, you know, the concern early was that maybe it was just a big seven rally and it was just going to fall apart. But what's happened is we've gotten the breadth to improve. So that's really important. The S&P has broadened out. The XLI index, the spider index, is actually at new highs. We're seeing airlines doing well, trucking and transportation is doing well. So that's not usually what happens if you have a recession around the corner. So that's putting a little bit of you know, uncertainty about when is this recession going to occur that everybody's been talking about. Is it going to occur? And maybe could it be possibly a soft landing? You know, maybe it's going to be a little softer than initially thought if it happens in late 23 or 24. But, you know, as a growth stock investor, you know, I'm following the markets. Stay away from the news. Just watch the markets, price and volume, breadth, new highs, new lows, or some of the indicators that I use to tell me, are we seeing accumulation in a healthy way, or are we seeing, you know, distribution? And, you know, this bull has been kind of a little bit slow to get started. I mean, it got some really powerful moves in January, but then the banking crisis kind of torpedoed it a little bit. But now we've really had a couple of good months. So I do think we're stretched, and we're going to come in a little bit in August. But, you know, we'll see how it plays out. I do think that we're going higher, but I do think a pause or a pullback would be actually very healthy at this point. And if the institutions truly are positioning, we will see accumulation on the pullback. The pullback will be fairly brief, maybe 5-6%, and you'll see a strong recovery. If the pullback goes 8 to 12%, more of an intermediate term correction, then maybe it's not as strong as we think, and it's going to take a little more sideways consolidation before we could have the next leg up.
Absolutely. Pullbacks are necessary, in my opinion, and they're healthy as well. Excellent points there. You know, it's been broadening. We see the breadth improving, a lot of higher highs, higher lows, industrials. You mentioned the many other sectors as well. It'd be nice to see some financials improving, but at least they're stabilizing. That's key. I mean, it was very scary with the KRE, and they thought it was going to be widespread banking crisis. And we know we've been in a pattern of regional smaller banks consolidating into larger banks. And that's been a common occurrence. So it's nice that that was put aside and we have a nice rally forming. You mentioned people are still, you know, skeptical. And I think that's important to help fuel the bull market. You need some bears to help fuel it, right? When everyone's
Absolutely.
bullish is when you need to get, you know, more fearful, right? And say,
Right,
maybe this is
right.
time that I, you know, pull out of the market, you know, when I'm at that near that top. So that's important that we have this scare, this fear of a recession. So that's probably helping fuel this bull market. And so I find that as a positive. Now, I want to talk about the seasonality as well as identifying leaders. I want to know how you identify leaders. Briefly, I'll just say I have my own investing puzzle. I look at a mixture of technicals, fundamentals. I tend to be a fundamentalist myself, and I always love looking at the fundamentals and the mathematical side of it. But of course, it's always about market reaction and what people think, because the market's made up of buyers and sellers and people, and it's based on human emotion. And we look at sentiment, the macro, all of that. I'm going to give you an example of SMCI because that's an example I always give. Excellent stock. And I always, what stuck out to me long time ago, back in 22, was when I saw that in the bear market, this company was raising expectations for earnings, coming out, beating their raised expectations, and then raising again. It was a pattern that played out at least, I think it was at least 2 or 3 earnings cycles. So that to me was a superstar. And of course, you know, anything can change at any time, but that was very exciting when I saw those fundamentals. And then the technicals, as we know, it's been pulling back now, which is healthy, but it's been shooting up like a rocket. So that's what I look for, and that's how I identify leaders. I like to know how you identify leaders. I know relative strength is probably important as well.
Yeah, I think what's important in a bear market is you need to keep following your weekly and daily routines. And that includes, you know, screening for stocks, watching what sectors of the market are leading. To me, it starts with sectors. We know that growth, at least for 2/3 of 2022, was horrible. You know, it got decimated. But you're always looking at the market for change. When do we start seeing change? And we, you know, when we got to October, we started to see change. There were stocks that were breaking out. Nvidia broke out. The housing stocks broke out. There were a bunch of others that started to move, and the XLK actually started to really turn up. So you said, well, maybe this has a little bit of a change. Growth might be able to perform. And if you're following your growth screens, and relative strength is so important. And you know, SMCI is one of them that even with the market trying to keep everything down, SMCI was kind of grinding its way higher and making these bases on bases. You say, geez, this thing is slowly going higher, even amongst the weight of a very negative bear market. And those are important to watch because when the weight of the market gets lifted, they're usually the first to pop out. And, you know, Nvidia's big earning report where they forecast, you know, a dramatic increase in sales helped the entire semiconductor AI theme. And SMCI is benefiting from that. And the other one that really was early to move was Rambus. It actually started to move while we were still in the bear market, and it was grinding its way higher.
I traded that one, yeah.
So Rambus was there, and you know, finding those stocks that have, you know, if you can find triple-digit earnings and sales, even amongst a bear market, you're saying that's rare. I mean, there are companies right now like, you know, Celsius, which is more of a retail beverage stock, is, you know, just got Pepsi on board to help them with distribution of product. It made a major investment, and they went through a couple quarters where they had to unwind previous distribution deals, and they took some charges on their fundamentals, but that's behind them now. And so I think we're going to start seeing some really great earnings and sales from Celsius. That's one. I know ON, which is the sneaker company, also has really good, strong earnings in sales amidst this bear market. Now, it got hit really nasty at earnings 3 months ago, but it's recovered to build a base, and it's right near the lip of the base right now. I do own a position in both of those stocks, Celsius and ON, but I think they have potential. And it's interesting, those are not tech stocks. So in addition to playing AI with NVIDIA and ACLS and Rambus and SMCI, there are other merchandise that is starting to emerge and get some traction. And so, you want to be doing your screens, because you have to be ready. And I know that, bear markets can, they, wear you out or scare you out. And I know some people kind of got discouraged taking a lot of paper cuts, that they didn't do anything when we started rallying because they were just scared. And now they're kind of saying, geez, is it too late? What should I do? My advice is don't panic. I mean, there's plenty of time to build your exposure in the markets. We're only a few months into this. I think what you have to do is, stalk the leading stocks. They're going to get some opportunities to either add to those positions, or if you didn't have that stock, there'll be a chance to get in, but you just got to manage your risk very carefully. You don't want to be buying, an extended stock, because that's not going to work out well.
Agree. Excellent points there. No chasing, no fear of missing out. These are common themes. And of course, that's what always happens is human emotion takes over, and you want to jump in. You're like, I'm missing out. But the market will always provide entries. And if it doesn't, there are more opportunities out there. There's always more opportunities. And that's the beauty of the market. And so it's always about risk reward. And as it gets up there and it keeps running, the reward is less than the risk, and the risk keeps increasing. So it's about buying right. And I always tell people, you make your money on the buy side. You need to buy right. And don't ever fall in love with the stock. You love your spouse or your family members. Don't love the stocks. You mentioned semiconductors. I've been bullish on semiconductors for, I don't even know, a year. Who knows? I don't even keep track of time anymore. But semis, cybersecurity. And I have a business that has remote workers. So back in COVID, I noticed the importance of having cybersecurity. To me, it's a core necessity. And so to me, I've been a bull on cybersecurity, Palo Alto, Fortinet, the long-term shareholder of Fortinet. I love that one long time ago. And Zscaler, love that company. I've been there since 2020, I think. Yeah, May of 2020. And so excellent companies there. And cybersecurity and semiconductors on. I don't know if you know On Semi, love On Semi, great earnings. I always love doing earnings reviews. They're just fun. I enjoy analyzing numbers. And so I always look for increasing margins, that's key, and increasing earnings per share growth. It's always about the earnings per share because we're shareholders. So I always look at that growth. PEs or PEs are just another number there. I don't pay as much attention to them. However, SMCI, that was another claim to fame that it had a PE, I think it was in single digits last year. It had such a beautiful number, right? So I was like, wow, for this one, I'm going to use the PE because it's just so beautiful. So I look at, and then beauty's had a nice run. Elf Beauty, these beauty stocks. So to me, growth is not just tech. It's Celsius. I traded that one. Remember when the news came out that Celsius, the crypto company, had issues, so they sold off Celsius, the beverage, with that news. And to me, that's like an inefficiency in the market. And I hopped in and I sold puts and I bought into that. I think it was in the
Okay.
70s at the time. And I did it, I made it a trade. So I don't have Celsius anymore, but great company. And those are the kind of opportunities that we get. The market's always giving opportunities. And like you said, you need to stay engaged. You have to be aware, and you can't let the market beat you up, that you take it so personally and that you miss out, because there's always new opportunities. We need to learn to come back quickly, experience our emotions. Emotions are key. Feel it, but don't act from them, and just come back stronger. And you mentioned Rhombus. I remember that one. That these are all screeners that I use to look at earnings per share growth. And these stocks had great, free cash flow yields, key. It's always about cash and the companies that are producing that cash. So these are exciting discussions. I love this. Oh, Bitcoin miners. Are you looking at Mara and Hut?
I'm not really into Bitcoin. I've never really fully understood it. I have friends of mine who are really into it, and they're taking advantage of Bitcoins and different coins and the miners, etc. I personally have stayed away, because if I don't really understand it, I'll probably screw it up. So I haven't really played in there, but they're moving.
Absolutely. I like Mara as a leader, great company. I actually, first time I bought into it was January 21. It was the first week of January, I remember. I think of it as the leader of the miners. Hut is a great company as well. They both keep Bitcoin on their balance sheets. I am bullish on Bitcoin. I think Bitcoin has potential for being a global reserve asset. I urge everyone to look into it. I have other podcasts on it. I actually interviewed Michael Saylor, who's excellent MicroStrategy CEO, and we talk about that in depthly. And it's, this fiat debasement is real. And I think Bitcoin has potential to be an alternative asset class. So very exciting there as well. You talk about automation and the future of money and currency. So there's just so much to get excited about. So seasonality wise, so we have August coming up and September. Those tend to be down, lower months. So, and then October, the end of the year, November, it picks up. Do you think this is probably a good time to stock those leaders on pullbacks?
Well, you're right. August, if you look at the last 10 years, August tends to be flat. There's a lot, trading tends to slow, and traders are away from their desks, they're vacationing. So it's the summer doldrums. And then September has not been a good month the last 10 years. It's been down, I think, 1.5%. And then, but after we get through those, October, November, December, January is actually seasonally the strongest period of the market. So, we've had a nice little run here up through July, and we're extended. So I think it wouldn't be unusual at all for the markets to come back in a little bit here in August. And when we get after Labor Day, it'd be interesting to see what traders do. Because if we come back in, we want to see what happens. Do traders come back in and say this is a chance to accumulate, or do the traders come back in and say no, we want to take some risk off? So we just need to pay attention to what's happening and see what it does. I mean, I think coming back a little bit would be 5-6% would be somewhere around the 50-day moving average, which would actually be very, very constructive. I think if we got support there, that would help set us up for maybe another leg higher later in the year. But as you know, anything can happen. There could be something that happened in the world with the war or with commercial real estate. I mean, I do think, the commercial real estate is something that I think is a little bit of a boogeyman here, because as an architect, we work with developers on commercial real estate, and with the interest rates spiking in the last year, a lot of projects are being put on hold. And I was reading a Bloomberg magazine article that came out in June. The cover was about commercial real estate, and it talked about 1.3 trillion in loans on buildings is going to come up by the end of 2025. And LA and San Francisco were cited as some of the areas that had extreme valuations have gone up so much that they're going to come down. Valuations of these buildings are going to drop anywhere from 10, 15, 20%. So when the loans come due and landlords need loans, it could be tricky to see if they're able to get to remortgage those properties within the valuations when they come back down. So it could stress the banks, these regional lenders again, if there are distressed properties. Hopefully it's contained, but you never know. I do think that's one thing in the back of my mind to say, what could derail this? I do think a hard recession, if things really, really went hard, that could derail things. I do think commercial real estate, which just seems like there's things in the pipeline with rolling over of loans and stuff that might be a problem. You know, I'm just keeping things in my back pocket.
It's always important to do that. You know, we can't get so one-sided and know it's bull market, we're going to go new highs, we're going to go 4,800 by the end of the year and have that narrative. You have to always keep that open mind and flexibility. Let me add a little more to what you just said. I'm very grateful that you brought up commercial real estate. Commercial real estate has many issues going on. There's shorter term loans there, so they're going to be up for refining, and we know that office is down. Their vacancy rates are gone up. We've changed the way we do business. Remote work is here to stay. And, you know, some people have gone back to the office, but it's changed. And those uses of commercial real estate are most likely going to be repurposed. You know, it's never doomed. I don't think we're all doomed and it's all over and it's good. In my opinion, it's not some big, you know, crash. I think people are smart and I believe in humanity. I think they're going to be repurposing them. They'll be smart about it. Sure, there'll be many that fail and they're going to be coming down, but it's gonna work itself out. However, there could be some negative repercussions in the near future. Pension funds have a lot of commercial real estate in them. So that's a concern. So that can affect that. So that's another thing to think about. There is a credit crunch going on. There's a lower demand and supply of loans. So that's another issue. And remember the data lag. There's a lag in data, about 24 months. So there's a decreasing money supply right now. We have the fastest shrinking since the 1930s. And this is from Steve Hanke, who's to me, one of the top economists. He's a monetarist. And he said that we're due to have a recession because of the shrinking money supply. The Fed is over tightening. There's a lot of different narratives out there. And so we just need to keep everything in mind and follow price, like you said. At the end of the day, the market is about following price and volume. And I love using the anchored VWAP. I think that's a great tool. So just follow price and always be ready for a shift or a change. And that's how we have to be. You know, the market's always changing. It's in a dynamic state. So just be aware of all those things. So, you know, seasonality, you know, we hope for the best. So hopefully at the end of this year, we'll see a new high. And now let's talk about mindset and risk management and psychology. I know we've touched upon this. I think we'll go head on with that. It's important to think different. And, you know, we had this brutal bear market. It was a sideways grind. And, you know, we were stuck in, you know, it was a difficult, 2022 was a difficult year. Some say it was one of the most difficult years of their career. And so with that in mind, there's a lot of fear. And people are taking profits early. If they see a little green, there's like, oh, let me cash out. And they're not riding these winners. And that the whole key is to add to the winners, trim your losers, and follow that trend. So how do you, John, shift that thinking and remain flexible to follow price and be objective?
Yeah, I have a slide. Let me pull up another slide here. Let's see if I can pull up something here. Sorry for the
Great.
Let's see, whoops. Did I actually not?
You have great charts, by the way, John. I have to tell you, I love your charts.
Thank you. Thank you. So I wanted to pull up this slide because I think it's relevant to the discussion. And it's a little bit about just crowd psychology in a bull market. And this is particularly relevant to coming out of a bear. You know, in this yellow box is where we are. We're coming out of this long, and if you're a growth investor, the bear market's been 2 years, not just all of 2022. We topped in 2021 in February.
Yeah. Oh, so, yes, that one. Yeah, the small caps really came down.
Small caps came down, IPOs and
For
things
me,
really started.
Absolutely.
They topped out.
So February or November 21 depends on your style of trading, I guess.
Yeah, that's when the yeah, I agree. That's when actually we saw the big seven start to get in trouble as the last big guys to top out. So when we're coming out of a market bottom, there's this conditioning that goes on. Everybody's probably trying to take positions gradually in a bear market, and they're taking losses. They're getting chopped up a little bit, and that conditioning over a year and a half, makes people fearful. They're afraid to take positions and take risk because they're just saying, look, I've been chopped up. And so what happens is once you get a bottom and we get a follow through day, and we're using, I'll say, the O'Neill system, and you see stocks breaking out, the public generally says, I'm not buying here because, for 18 months, all breakouts have been failing. So they don't trust it. And all of a sudden they let it go, and the stock moves up, and the breakout actually starts to get a little bit of traction, which is, again, market change when breakouts start to get traction, because we had not seen any traction for a long period of time. And so the public says, well, they want to be sure, because they're fearful, and they're either going to, the first little normal reaction, they'll get scared out and they'll say, okay, I'm taking my 5% gain, my 6% gain. I don't want to take losses. Or they'll make it through this pullback, and they might get a 15, maybe even a 20% gain, and they immediately sell it and lock it in. And, when you're starting to see broadening of the breadth, breakouts getting some traction, tech stocks, growth stocks actually working, that's important change. And you do not want to be selling for 10, 15% profits. But that's not the mindset of the general public. They sell things quickly, and it's all about fear. They're so fearful, and they've been conditioned to be fearful, that it takes a while for that to change. And that's why sometimes retail investors, there's FOMO. They buy way up here, and the market has a normal correction, and they're buying extended stocks, and they get burned again. So, the psychology at the bottoms is the news is terrible. People have been beat up, they're fearful, and they tend to take quick gains. But if you've been through market cycles and you see the breadth and new highs, new lows improving, you should actually be holding, to try and build your position, concentrate your money in some of the winners and some of these leaders that have really made themselves known. And one of the things that I use that really has been, it's a kind of a core tool that I use is, I look at new highs and new lows.
Yes, the breadth.
Religiously. And this was in my general market video from, I believe it was, not sure if it was a week ago or 2 weeks ago. And what was important, was we have the new lows. This is going all the way back to November of 2021. Here's the new lows, and green are the new highs. And, we're looking at, we want to see new highs. And you can see new highs now are actually exceeded January, which is really positive, and we're up near where we were in November of 2021. That's very positive. But more importantly to me is the new lows are shrinking. So that's giving us net new highs that are actually looking very strong, because we're not having new lows. There aren't stocks breaking down. And if you look back at the bear rallies that we had last March and April, we had lots of new highs, but look at the new lows. So you're not getting the net number was not very, very strong. And then the July, August rally of last year, again, we had some net new highs, but new lows were still fairly persistent and kind of negating the new highs. This is different.
Oh, yes.
This is very different. So that's important. Ultimately, in a really strong bull market, we want to see the new highs way up in the 200 or 300 range. But given we're coming out, and this is kind of an emerging bull market, this is a very good sign right now.
I have to stop you right here. This is worthy of being a pin chart. I have to tell you, this is a beautiful, excellent example from November 21 to where we are now. And it visually demonstrates the change and the change in the market. Look at that October 22, which many say was the near-term bottom, and some even say it's the bottom. Look at that red, how many new lows were formed. And now you barely see any red, and it mirrors a little bit of January where it started and November 21. This is significant.
Yeah, I think what's important and what I also look for is divergences. And you'll notice that the peak new lows really climaxed in June.
Mm-hmm.
And you'll notice that when we got to the October lows, we had less new lows.
Mm-hmm.
That was a clue that maybe we were near the bottom. This was diverging because
Yes.
the market made a new low, but we did not have new lows that exceeded the June point. And then when the markets came back down and retested in December, you can see the new lows
Yes.
dried up dramatically. So again, that was a clue. These two divergences were a clue that maybe things were changing and the market was gonna hold up. So those are just some divergences that were giving some clues that, you know, maybe the bottom in October was in. I know that some people say, well, we didn't get a climactic bottom. I actually believe the climactic bottom happened in June, because if you follow new highs and new lows, the weekly new lows in June were 50% of all issues traded. That was the climactic selling, I believe, in this market, and the volume got up to, I think it was 30 billion shares on the NYSE. So, you know, these divergences at a market bottom can help you with trying to sift out if something might have some legs or not. But I do think this is really important, that new lows are shrinking as we're getting some new highs. So that's positive.
Very positive. And that little blip right there in March, April was we know it was due to the banking crisis and fear. So, and that didn't even come close to being where October was. So that's significant as well. Even something so dramatic as, you know, collapses of banks. And they say that they were like the top three, or, you know, I guess adjusted for inflation, they were like the top three we've had. So that's significant. That's a beautiful chart, John. I love that.
Thanks.
You know, it's important to ignore the noise and look at the net numbers as you demonstrated. That's key. So I think we need to go into the emotions and feeling, which are integral parts of decision making. And it's important to know that we are feeling beings, and it's okay to have feelings and emotions. And so with that in mind, it's key to not act upon that. So we need to separate intuition from impulse. And we also need to be aware of the biases that occur with traders. And we have biases such as anchoring, recency bias, overconfidence is a big one, and framing. I'm going to mention all of these, and then I want you to take over and tell me your thoughts. Framing, we have loss aversion. So in how things are framed affect our decision making. If things are framed in a very negative way with losses, we tend to take more risk because we are loss averse. So what are your thoughts on how traders can overcome these biases to make better decisions?
Yeah, the psychology of the market is really important, and your own psychology is important. And that's why, you know, being flexible is so important. And when, you know, you talk about, there's, in a way, the market there are so many tools and indicators that you can tap into. One of the things that, you know, it's important is to sort out which indicators help you with evaluating the market or a stock. I try to keep it as simple as possible to have. The point is, you might only have 2, 3, or 4 indicators, but really trust them because they work. You've seen them over time. They work. They get you on the right side of the market. Everybody has an obsession with finding the perfect indicator. There isn't one. There isn't one at all. The market is a big crossword puzzle, and you need to put together these pieces with maybe a couple of your indicators and say, what is it telling me at this time? And use that, whether it's to place a trade or take off a trade or to get aggressive or to get more defensive. and try to, take some of the emotion out of it. Having rules, buy and sell rules, will help you with saying, look, I'm not going to buy or sell just on how I feel today. I'm going to basically have some defined buy rules. Do I buy breakouts? Do I buy pullbacks? Do I buy, weekly pullbacks, daily pullbacks? It's not enough to say I buy pullbacks. You say, well, what is your system for buying pullbacks? What specifically does a stock have to do to meet your criteria for a pullback that's viable? So you have to have your methodology and what works for you. You want to have a few general market indicators that you trust. Not about quantity, it's about trusting the ones that you have. But recency bias is really, really powerful. Whether it be like we just talked about, and you're saying, wow, everything's working, I'm going to really load up. That can get you into trouble. Just because you've had, you've gotten out of the gate with some winners, that's great. You still need to manage the positions and be objective to say, if I see some real danger signals and sell signals, I need to act, not just because I feel good because I'm up 50%. So very real stuff, recency bias.
Absolutely. Excellent points. Anchoring to price targets from analysts, as well as recent prices of stocks, saying, oh, this was cheap, I got to buy now. And then it goes lower, or saying this is too expensive, and now then it gets more expensive. So it's all those phenomena going on in our minds, and we just need to be aware and identify it. And you mentioned rules, and rules are key. And I always say it's important to have your rules before you enter the trade, because once you're in the trade, your emotions are involved, and it becomes increasingly challenging to implement anything. And we always want to change, but we need to follow our rules. It's about knowing yourself and your style and what works for you. Now, information overload. And that's, I love that you brought up the indicators. And that was actually my next question, to ask you what your favorite indicators are. Everyone has their own indicators. There's no perfect one. However, the problem, in my opinion, is that there are too many of them, and there's just too much information, and we have bandwidth constraint. So the more information, the worse it gets. We need to sort through, and at some point, all this information just becomes noise. And there's a lot of opaqueness out there. And I'm going to give a quote. This is a great guy, Herb Simon, who's the father of behavioral economics. He said, a wealth of information creates a poverty of attention. And I think that's so true in trading. And so my question to you is, what are your favorite indicators? I know you keep your charts clean. And how do you decipher signal from noise?
Yeah, the indicators that I use are pretty straightforward. I look at the new highs and new lows, as we just looked at a chart there. I look at the advanced decline line relative to the index, the S&P. I also look at the percent of stocks above their 200-day moving average on the NYSE. So those are three that keep me on the right side of the market. Then I look at the action of the leading stocks. There are definitely some leading stocks right now. There's a good dozen, or you'd say, are real leaders. I'm watching those. Even if I'm not owning a position, I'm watching them. I want to see, is NVIDIA remaining strong and not giving back a lot of its gains, or is it breaking down? So I watch the leaders very carefully, and I actually I look at the leaders over a 10-day window, and I look at their distribution days in a leading stock over a 10-day window. 2 distribution days over a 10-day window is okay, it's normal. They can shake that off. It's kind of normal profit taking. When you get 3 or 4 distribution days in a leading stock in 10 days, that's a caution sign that maybe institutions are starting to distribute the stock. And you really need to probably go deeper in looking at the trend and where it is relative to moving average, but it's certainly on alert. So I look at the leading stocks carefully. I look at the RS line carefully, particularly as they pull back. What is the RS line doing? You know, there are so many indicators with all the software programs that it'll just get confusing. If you try to look at 12 indicators, you know, 5 of them will give you bullish signals and 5 will give you negative bearish signals, and 2 you won't be able to interpret, and you're like, I don't know what to do. You know, you get kind of frozen. So you have to find what works for you, and different indicators. You know, if you're a day trader or a swing trader, your indicators are probably different than mine, because I'm a position trader. Do take a few swing trades, but generally I'm a position trader. So your indicators need to fit your time frame, need to fit your methodology. And everybody wants indicators to say, well, that's not good enough because that one's not predictive. I say, I'm not looking for predictive. We're not in the prediction business. We're in the interpretation business. So every day we want to interpret the action to say, is this, you know, strengthening the thesis of a bull market and the uptrend, or is it weakening it? And you want to be flexible to react. You know, should I be reducing positions, increasing positions, just holding positions and managing them? Everybody wants a predictive magic elixir indicator. It doesn't exist. All you can do, the best you can do, is stack the odds. If you have multiple indicators that you trust and they're all right now favorable and bullish, that's an edge. Saying I've got 3 or 4 of my indicators that I trust that are all stacking in a bullish scenario. That's the best you can do. It's not a guarantee though, but that's the best you can do. And we just react and be flexible. It's important not to get locked into any mindset. That's why, you know, people say, well, is it really a bull market and this and that? I said, stop labeling it a bull market. Right now, clearly we're in an uptrend. I don't know if this is going to roll over in August. I don't know if it's just going to consolidate and keep the uptrend moving higher, but I don't need to know. I just need to look at the market every day, evaluate, you know, what I see, and make adjustments as necessary.
Wise words. I love that. That was an excellent discussion that you just gave, and valuable insights there. You know, it's about simplicity and simplifying these indicators. There's just too many of them, and it does get very confusing. And, you know, we don't need to fall into any narrative and mindset and fixed mindset. We need to be flexible, open-minded. And so not predicting, nothing is going to predict. No one knows the market. And that's the beauty of the market. It's like an ocean. And, you know, you can never really conquer this market. And so we need to react. And that's key. And I like to think in probabilities. And we always think of, you know, there's no absolutes. And we look at the charts and follow the price. And we think this is most likely, you know, where it's going based on the trend. And trend is key. And I love that how you mentioned the distribution days. You know, 1 or 2, it's okay. But once it gets to 3 or 4, maybe there's a change in the trend. And that's when we need to be more cautious. It may not just be a pullback to going higher. It could be a change. So those are excellent indicators. Thank you so much for that. Now, you're a position trader. Please tell us about your strategy on getting exposure to positions. How do you scale into your positions? Do you have progressive exposure?
Yes, I definitely practice progressive exposure and taking the feedback that I'm getting from the market. You know, originally, I would say, you know, 10, 15 years ago, I really was a breakout can slim traditional trader. Over the years, I have you know, found more advanced entries, downtrend lines and bases, you know, looking at some other tactics to try and get into a stock that I believe is under accumulation, looking at the chart to try and get an initial position. And when I take my initial position, if I buy 2 or 3 pilots, I usually take the exact same size. And the market's going to tell me which one deserves more money. If one starts to work and start getting some gains, that's telling me it's the stronger stock. If one gets stopped out, it gets, you know, kicked out of the mix. But then hopefully by doing it this way, then when it actually breaks out, I may even have a good 10% position before it breaks out, so I don't have to touch the breakout, which can be turbulent. Or if it's something that I really think is a lot of potential, you know, I can add another 5% on the breakout, but my average cost is still in the base. So if it comes back and retouches the base pivot line, I'm not under severe pressure. The other thing that I've added to my trading in the last 2 or 3 years is I was always a buyer of strength. And I felt it was a weakness that I really had no technique to buy pullbacks. Part of it was just my psychology, the way I bought strength, but I said I really need to work at developing some pullback strategies. And so I've now developed kind of looking at weekly charts, a pullback strategy. And then I have a kind of a technique I use on daily charts with a pullback strategy, which allows me to incrementally add to positions. I would not initiate a big position off of a pullback from a stock that's broken out, but I use it to kind of force feed and add incrementally to positions, to take a position from 15% up to 20%, to try and get a little bit more money into what I think are the leading stocks.
Very nice. I also scale in and out of positions myself. So great strategy there. And you know what I love hearing as you speak, John, is that you're always learning and you're tweaking, modifying, improving, growing, and you're so humble. These are noble traits of a trader and anyone in life in general. So this has been so wonderful hanging out here with you and speaking about markets and sentiment psychology. Please tell us about your Blue Sky investing event. I believe there's one occurring pretty soon.
Yeah, let me call up a slide.
And tell everyone how they can stay in touch with you as well. Oh, I love that chart. That's a great chart. Okay, so save the date.
Yeah, save the date. The Blue Sky investing event is something that I originally created with the Boston IBD meetup, and the first one we had in 2018, we had 30 people on a Saturday, over at MIT. We just got in a room and we talked stocks all day, and it was small. And when COVID happened, we decided to bring it into a virtual meeting, and people really liked it. What we did is we get external speakers for a variety of topics. And we put together an all-day event. And with the virtual nature now, we're getting people from all over the world that attend. We get a lot of really great speakers. I mean, well-known speakers. Minervini's been on it. Ropel's been on it. Jared Tendler's done a psychology segment for us. So we get Scott O'Neill of O'Neill. He was on with us last year. So we get a lot of great speakers that people like to hear from. And we put together this all-day event. So it's going to be November 4th. I'll be tweeting out and sending out some information on this. We're going to be announcing our speakers that we were just about solidified for this year. But it's a great event all day. There are recordings made. It's Zoom, so everybody can participate, or even if they want to watch a recording. But we would encourage people to enjoy this event. It's our 6th year.
Awesome. How do people sign up for it?
We will get information out primarily through my Twitter feed. Okay. And we also have a mailing list for people that are part of the IBD Boston meetup. So there was like 3,000 names there. So we will get the information out, and maybe I'll get it to you and some other key people to tweet out as well.
Perfect. Will do.
We'll show people the agenda. We'll give them the links to, we do charge a small fee for the day, because we got to pay for Zoom and storage and all that kind of administrative stuff. But believe me, it's well worth it to hear what
absolutely.
These speakers
That's
have to say.
Incidental nominal fee for the value of this event. And I hear there's another great speaker attending named John Pocorobba. Is that right?
Yes, I usually speak at the event. Since I'm the host, I always do a talk. Actually, this year it probably interests you. I'm doing the talk is titled, what's it called? The Irrational Behavior of Rational People.
Love it.
And it gets into some of the heuristics and things that you mentioned about these
biases. The heuristic, the availability, controllability, and uncertainty heuristic. I love that. Oh, this is exciting. I can't wait to watch you speak about that. This is
I should consult with you, because you probably know more about some of the heuristic stuff than I do.
Well, whatever I can do to help to make this event even better. But what an amazing event. This is awesome, really exciting. I can't wait till you give me details. I'll definitely be tweeting about it. Now tell us about your Twitter handle. What is it at?
Yeah. Here it is on the left. Can you see this?
Right there, at
Yep.
Rain King
Yeah. At Rain
LLC.
King LLC is my YouTube channel, and I do general market
YouTube, yeah.
updates every week. I do post a general market update. They're free. And there's my Twitter handle. It's Rain King at
Okay.
JPoco722.
Got it. Oh yeah, JPoco722. And then your YouTube channel, another great, we're going to be linking that YouTube channel to this channel. So that's at
That's
Rain
great.
King LLC. And you have great videos, the GMU, you call it. And you have that. You do like weekly videos, and then you have that extra as well, correct?
Yes, the general market is a weekly. Usually it comes out on a Friday. And then what I've done in the last few months is I'm doing these short videos called GMU Extras, where I'll take a trading topic. This happens to be an example of a high type flag pattern, but they're short videos. They're only like 10 to 15 minutes. They isolate on some trading topic. People have given me suggestions, things they want to hear, and they're pretty well received. But those come out. They're a little bit more sporadic. They might be, sometimes they're weekly, sometimes they're every 2 weeks, but they go up on my channel, and if you subscribe to my YouTube channel, every time they're posted, you'll get a notification if you subscribe. So those two things, and those are all free.
Awesome. Exactly. I was just going to say, so much value, and it's all free. So thank you so much, John. This has been awesome. We'll definitely have to meet up again and do this again, because this has been great.
Yeah, thanks for having me this morning. It's really been a great conversation. We covered a lot of ground, and again, I really hope people are tuning into your YouTube channel as well, which has a lot of great content, particularly some of the macro stuff and some really great speakers.
Thank you so much, John. And thank you to all the listeners.